Buying a house in Canada right now feels trying to climb Mount Everest without oxygen. Prices are sky high, down payments are massive, and if you're just getting started in your career, it can feel like the dream is slipping further away every year. But here's the thing, the government actually gave us a tool to make that climb little easier. It's called FHSA, or First Home Savings Account. Here is why that matters. The FHSA gives you tax breaks now, lets your money grow tax free later, then lets you cash it all tax free when you buy your first home. It's basically free money if you play it right. Most people don't even know how powerful it is. So in this video, I'll walk through everything. What is FHSA, how it works, how can open it and who can open it, the mistakes to avoid, and some real life examples that will make you go, wow, I need to open one right now. So, what the FHS actually is, let's start with the basics. The FHS stands for First Home Savings Account. It's a registered account, which just means the government gives its special tax rule, kind of like an RRSP or TFSA. The easiest way to think about it is this, you put money in and you get a tax deduction, just like an RRSP. While it sits in there, your money grows tax free, just like a TFSA. And when you pull it out to buy your first home, you don't pay any taxes on it. So you are winning three times: tax savings when you put in, tax free growth while it's inside, and tax free withdrawals when you are ready to buy your first home for the first time. Who can actually open a FHSA? Now, not everyone can just walk into a bank and open one. There are few rules. You need to be a Canadian resident with SIN, be at least 18 years old, and you have to be what government calls a first-time home buyer. Now, it doesn't mean you have never touched real estate in your life. It means you haven't lived in a home you owned in this calendar year or the last 4 calendar years. For example, if you bought a condo 5 years ago, lived it in for 2 years, sold it, then have been renting since then, congratulations, you're first time home buyer under these rules. It's actually more flexible than people think. And that's good because life happens. Maybe you sold your old place, maybe you lived abroad, maybe you just couldn't afford to buy again. The FHS still works for you. The numbers you need to know. Although let's talk about the money limits because this is where most people either get in or get lost. Here's the breakdown. You can contribute up to 8,000 per year. Over your lifetime, the max is $40,000. If you don't hit 8,000 in a year, you can carry forward up to 8,000 of unused room. So let's say you only put in 3,000 this year, next year you could put in 13,000 total. But don't get it twisted. The carry forward isn't unlimited. You can't just skip 5 years then jump 40,000 at once. And here's timing rule. Once you open an account, the clock starts. You have got 15 years to use it or until you turn 71, whichever comes first. So the sooner you open, even with small deposit, the better because it starts with 15-year countdown. Why FHSA is so powerful? Okay, let me show you why this account is such a game changer. Say you make 60,000 a year and you put 8,000 into your FHSA. On paper, the government sees your income as 52,000 instead 60,000. That means you could save about $1,600 in your taxes right away. That's the money you back in your pocket at tax time. Now, here's the kicker. You can't take that refund, the 1600, and reinvest it. Some people put it into their TFSA, some back into their FHSA, some just save it for closing cost. Either way, that's bonus money. Then your FHSA money grows. Let's say you invest into simple ETF. Every dividend, every gain, every cent of growth is tax free. And when you finally buy a house, you take the money out tax free. So if you put 40,000 over a few years and it grows to 50,000, you just got 10,000 in gains without paying a single cent of tax. That's why FHS is basically free money if you disciplined. How it works when you buy. Alright, so when it's time to actually buy, how to get your money. It's so simple. You tell your bank or brokerage you are withdrawing from FHSA for a home purchase. And as long as it's for qualifying property, they send the money tax free. The Key is you have to intend to live in the home. You can't be just investment property. And here is a pro move. If you can combine the FHSA with RRSP Home Buyers Plan, that lets you take up to 35,000 from your RRSP for a home tax free as long as you pay back it over 15 years. So if you plan well, you could stack 40,000 from your FHSA and 35,000 from your RRSP. That's 75,000 toward into your down payment. For most first-time buyers, that's the difference between scraping by and actually being able to afford the price. Let's put this into a real story. Imagine Alex, who is 24 years old, just started working. He opens an FHSA and puts in the max 80,000 per year. Over 5 years, that's a 40,000 total. Each year, Alex saves about 1,600 in taxes. So over 5 years, that's 8,000 back in his pocket. He invested that money in like balanced portfolio, and by the time he's 29, his FHS is owed 50,000. Now Alex is ready to buy a condo. He uses 50,000 from his FHS and 8,000 in tax refunds he saved. It's total 58,000 for his down payments. Without the FHSA, he would only have 40,000 saved, but with it, he got almost 20,000 more. That's life-changing when you're trying to qualifying for a mortgage. Mistakes people make. Alright, time for some warnings because people do screw things up. Over contributing. If you put in more than your limit, you get hit with 1% penalty per month. So if you are over by 1,000, that's a $10 a month until you fix it. Pulling money out of non-home stuff. Yes, you can technically take money out of anything, but it's taxed like income. Imagine withdrawing 20,000 in a single year. You just bumped yourself into higher tax bracket. Ouch. Not investing. Leaving your FHSA as plain cash is the slowest way to grow. Even safe gig are better. Remember, the account is tax-free growth. Forgetting the 15-year rule. You can't just let these things sit forever. At some point, you either buy a house or transfer it into your RRSP. So yeah, don't treat your FHSA like a regular savings account. Play by the rules and you will win. Now what if you don't buy a house? Here's the cool safety net. Let's say life changes and you never buy a house. You meet someone who already owns, you move abroad, or you just decide to renting works better for you. Guess what? You don't lose the money. You can roll your FHS into your RRSP or RRIF tax-free. So worst case, it just become retirement savings. You still got the tax breaks when you contribute. You still got tax-free growth, and you can still use it later in life. No downside. Now, how to open one and smart strategies. Opening one is easy. You just walk into your bank, credit union, or log in into your online brokerage. Most of them have FHSA ready to go. But here's some pro tips. Don't just open a plain FHSA saving account. Open an investment FHSA so you can buy ETFs, mutual funds, or gigs. That's where you get growth. But two, if you are in lower tax bracket now, but expected to earn more later, you can still contribute today, but wait to claim the deduction until you are in higher bracket. The way your tax refund is bigger. Use your tax refunds wisely. Don't blow them on gadgets. Either add them back into your savings or use them to cover extra housing cost when you buy. So here's the bottom line. The FHSA is one of the best financial tools for Canadians right now. It gives you tax-free savings, lets your money grow without tax, and then lets you take it all out of tax-free when you need it most, your first home. If you're planning to buy in the next 5 to 10 years, do yourself a favor and open one now, even if you only put a little bit. You are starting at the clock and giving your money more time to grow. Alright, the FHSA explained. If you found this helpful, hit the like button, subscribe for more money and investing tips. And drop your FHSA question down below. I'll be doing follow-up video comparing FHSA versus RRSP versus TFSA, so don't miss it.